Hello, Steve Koukoulas here, Economist-in-Residence with Zagga, with our regular monthly update on the economy. And again, another tumultuous month has just passed. We've had, in no particular order, the third interest rate hike from the Reserve Bank of Australia. They've lifted rates by 25 basis points to 4.35%. That's 3 rate hikes since the start of the year, and it completely unwinds the 3 rate cuts that we saw in 2025. So interest rates, as the RBA Governor, Michelle Bullock, noted, are restrictive. And I think you don't have to ask too many people around to see how much pressure these high rates will be having on consumer spending and on businesses who have loans and overdrafts and the like. So the question now is, will there be more rate hikes? The RBA Governor was actually a little bit contrite, if you like, that she was sort of saying that, look, we've got rates at a level where we can deal with the oil price shock, that we can deal with the economy more broadly. So it was sort of a hint that they're going to be on hold for at least another meeting, perhaps 2, before they see the next round of inflation data, analyse what's happening internationally, and see just where the domestic economy is going here in Australia. And of course, internationally, it's all about oil. It still seems to be stuck in a sort of range near $110 a barrel. That's still very, very high, almost double where it was pre-war. So the petrol price shock is still being felt globally. That's impacting on Australia. So in Australia, in terms of the hard economic news, we've had consumer sentiment and business confidence down, and down markedly, not dislike the reaction in the COVID pandemic or the global financial crisis from 17, 18 years ago. So consumers and businesses are now turning pessimistic. We've had household spending growth, very funny result, if you like, because it was strong in March, but when you dig into the details, it's because all of us were filling up with petrol. So petrol sales boomed. If you take them out, spending was still up, but only up marginally. So the household sector's in the early stages adjusting to, well, the petrol shock and the interest rate hiking cycle that started in February. On housing, that's where I'm going to spend a few moments because there's a lot unfolding there. And it's mixed news, to be frank. On the construction side, new dwelling construction, new supply, if you like, there's still generally good news. A number of building approvals, while they're very volatile month to month, if there's a large apartment block that's been approved, 1 month they jump up, next month it comes back down. But if you put a trend line through the building approvals numbers, they're strongly higher. You've got, in the last 3 months, an annualised rate of dwelling construction just over 200,000 dwellings. So that's good news. So the supply side's coming on stream, even though a lot of property developers are noting that their input costs are going up more than the rate of inflation, and there's still labour shortages, the available tradies and the like to build the dwellings. So that noted, it does appear as though we are seeing some form of reasonable and reasonably strong lift in dwelling construction through the course of the next year or two, because of course it takes quite a while to build a dwelling. So that's a positive sign. On house prices, there's some emerging news coming from both Cotality on house prices and SQM Research, who look at asking prices for dwellings. Both are weakening. Well, on actual prices, Sydney and Melbourne prices are down a little bit, but down nonetheless over the last 4 or 5 months, and that's a sign that supply and demand pressures are unfolding there. The rate of increase in house prices in what we call the boom cities, Adelaide, Perth and Brisbane, is slowing. And we look at the SQM data on asking prices just in the most recent week. I know weekly data can be very volatile, but in the most recent week, we've got asking prices actually falling in all the capital cities except for Darwin and Hobart. So there's something brewing in the housing sector. And I don't want to get too gloomy too early, but it does appear that with new supply coming on stream, with the unemployment rate creeping up a little bit higher, and demand from immigration cooling off. Immigration is still very high, don't get me wrong, but it's not as strong as it was a year ago. That maybe we're getting into this perfect storm for dwellings where we're going to be seeing house prices weakening through the course of the year. At this stage, I don't want to be too pessimistic, but it is something that's moved to the top of my radar in judging where the economy is going, because falling house prices have huge implications for consumer wealth consumer confidence, and of course bank balance sheets if you've got house prices starting to come down. So in summary, the economy is slowing down. Inflation is too high. We know that both the underlying and the headline figures are too high, and that's why the Reserve Bank's hiking. The economy is weakening, the unemployment rate's starting to rise, and that's a cocktail which is, really, I'm not gloomy yet, but I'm starting to get nervous about the second half of 2026 as being one where we perhaps could be seeing, a period of very weak economic growth coming through. Not a recession at this stage, but very weak growth coming through. Gosh, I look forward to chatting at the webinar in the next couple of weeks and seeing you all around the traps in the weeks and months ahead. All the best. Cheers.